Just as you thought inflation was a thing of the past, Saudi Arabia just cut their production by 10%. This is a move to try to get the price of crude to go higher and to stay higher. Saudi Arabia, as well as a lot of Middle Eastern countries, believe that a global recession is coming, and they want to front run this by jacking up the price of oil. This is obviously a problem and could be a cause of concern for equity investors because this ultimately will lead to higher inflation. And what's worse than that is higher inflation expectations, in which you've already seen inflation and expectations moving higher recently. This really creates a problem for the Fed. At the same time, the stock market is surging. Is the Fed about to rug pull us? Where will inflation and inflation expectations need to go to get a rug pull? How close are we to seeing further tightening from the Fed? We'll get into that here in this video, but I should also point out what just came out here over the last couple of minutes is the chief of the IMF, the International Monetary Fund, says there is no significant slowdown in lending and the Fed may need to do more. This all comes at a really bad time. Just as we thought inflation could become a thing of the past, or at least higher levels of inflation. Let's get into all of this information. Hit the like button and subscribe to the channel if you learned something out of this video and you want to stay up to date with what is happening in the markets. So what's the latest? Well, as of Sunday, Saudi Arabia announced a 1 million barrel cut per day to the oil supply. Saudi Arabia, before yesterday, was producing about 10 million barrels per day. So this is a cut of roughly 10%. Well, what Saudi Arabia actually said is that they are willing to act unilaterally, that they don't really need other OPEC countries to cut their production. They will do it if they feel that they should. Now, they said, quote, "We have a potential for supply to be a lot bigger than where demand growth is going," he said, citing the potential of a recession on the horizon. There is no guarantee that oil prices won't go below $70. And they really want to keep oil prices higher. And this would make sense if a recession was actually coming. You don't really want oil to be low heading into a recession if you're an oil producing country. Because when you go into a recession, the world uses less oil. There's less transportation and commuting. There's less travel for business. There's less shipping of products worldwide. There's less demand for oil. So this could be the first production cut in a series of production cuts. Now, OPEC did cut the production of oil back in April by 1.66 million barrels. So this move from Saudi Arabia is almost equivalent to the surprise move that OPEC made back in April. Now, this production cut is leading analytics firm Raptian Energy to tell CNBC that, quote, "We see large global deficits materializing in the second half of 2023 and crude prices exceeding $100 next year." He added, for oil to really exceed $100 per barrel, you would need to see very much a non-recessionary environment. This would be an environment where inflation would be very high and where the Fed would need to continue to raise rates. When you start to get recessionary data that comes out, the first thing that's affected is oil, for the reasons that we previously mentioned. So on one hand, $100 barrels of oil by 2024 likely means a soft landing is happening, or at least the economy's not crashing at that point, because that would be good oil demand to see $100 barrels of oil. but that would also mean the Fed would have to rug pull us. But really, why this production cut or upcoming series of production cuts could be so negative for inflation specifically is because of the dynamics of oil. Now, oil itself is used to make products, right? Plastic being one that you guys can all relate to, but other products as well. But that's not really what affects inflation. What really affects inflation when it has to do with oil and the price of oil going higher is transportation of products. It makes shipping products more expensive. That's number one. Everything you buy in a store is affected by the price of oil. It was distributed to the store. You drive to pick it up. And a lot of the times you're going from warehouse to this warehouse to, well, obviously manufacturing first, then to a warehouse, then to another one, and then to a Walmart shelf, and then you pick it up. So it gets affected by oil, price of gasoline ultimately, many, many times. So just the price of oil going higher can lead to increased prices for those products. Now, this would come at a really bad time where you've really seen goods inflation fall by quite a bit. Goods inflation is not the problem here. It's service inflation. So in theory, if you get the price of oil going higher, affecting goods prices, making those more expensive, and services don't roll over, then you're going to have red hot inflation again. And what you've seen recently has not been very encouraging, specifically with some of the leading indicators of longer term inflation expectations. This is a chart of the Michigan consumer inflation expectations, a 5-year chart. And what you've seen is from the lows of October, inflation expectations 5 years out was 2.7%. It has been on an upward trajectory ever since. It really baselined at about 2.9%. In April, you've seen this jump to 3%. In May, you've seen this jump to 3.1%. If this trend continues higher, oh boy, are we in a problem. Look at this chart on a 10-year basis. When this chart breaks out, you tend to have problems with inflation. And really the Fed, that's what they care about, is inflation expectations. Once inflation gets to a point where inflation expectations are in topics of conversation at the dinner table or with your family and friends, the Fed will really have to rug pull us. Because inflation expectations going higher leads to higher and stickier inflation. Think about it like this. If you are a business owner, call it a small or medium-sized business owner. If your customers expect to pay higher prices and your food producers expect to see higher prices, call it if you're a restaurant, pretty good example for this. If food producers expect higher prices, well, they're going to raise their prices. Then, if your average citizen expects higher prices in restaurants, well, restaurants are now paying more for their food, for an example. Their customers expect higher prices. Why not just raise prices? And this basically happens throughout the whole entire economy when inflation expectations get, as the Fed says, unanchored. So you've actually seen signs recently that inflation expectations might just become unanchored. And really the only time that you've seen the longer term inflation expectations come down by quite a bit is when the stock market fell and was hitting the October lows. This is, again, the 10-year chart on inflation expectations on the 5-year horizon. And really ever since COVID, the only drop you really seen that was sizable since you've had high inflation was right here. And this was the crash from August to October. So maybe you need to see one of those. Maybe the Fed wants to see one of those. Now, I'll give you guys my opinion on this towards the end of the video. and it's not as doomy and gloomy as some of this data might look, but you got to acknowledge the bear case as well. Now, for the first time in a long time, ever since COVID, really 2021, around February of 2021, core CPI is now higher than headline CPI. Headline CPI includes food and energy, volatile sectors of inflation. Core CPI does not. So core CPI is going to be more or less your services. It's going to capture goods, but it's not going to capture food and energy. Well, excluding food and energy, inflation's going about steady. It's not really going higher. It's not really going lower. Some of the month-over-month numbers don't look very encouraging. On an annualized basis, you're still at about 4.8% month over month with the core CPI numbers. But really what this shows is that if the price of oil does go higher, it's gonna bring up headline CPI. It's gonna continue this upward trend on core CPI. And that's going to be a huge problem for the Fed. And again, considering that stocks have went parabolic in 2023, the Fed's going to look at this like they have room to raise rates, that they should raise rates. Because, I mean, the only time inflation expectations really went down is when the markets were falling. If you were the Fed, what would you do? And keep in mind, the Fed, generally speaking, does not have positioning in the markets. At least they're not really supposed to have directional positioning in the market. So what do they care? I mean, it's not like they have a self-interest in seeing the markets go up or down. It's all about inflation and inflation expectations, more importantly. Also, what you're getting here on Sunday is the IMF chief that says there's no significant slowdown in lending and that the Fed may need to do more. The IMF's managing director, Kristaliana Georgievna, told CNBC, quote, "We don't yet see a significant slowdown in lending," stressing that the world economy is in an exceptionally uncertain environment. Pay attention to trends and be agile, adjusting should the trends change. A majority of major global central banks, including the U.S. Federal Reserve, have tightened their monetary policy aggressively to tame soaring inflation. And there's this argument that the last time you've seen inflation the way that we recently have was in the 70s and 80s. Maybe raising rates no longer affects inflation the same way that it did in the past. I would argue that's probably somewhat correct. I mean, everything's digitalized now, and there's vastly different economies. So what if the same interest rate policy then was twice as effective as it is now? Well, that means maybe rates do need to go a lot higher. And maybe that makes sense why inflation is staying very sticky. And they basically said that the Fed needs to do more. Let's spare you guys the time of reading this whole article. Link will be down below in the description of this video if you guys do want to go ahead and take a look. But I do want to read these two paragraphs right here. It says, quote, "The pressure that comes from incomes going up and in unemployment being still very, very low means that the Fed will have to stay the course, and perhaps, in our view, they may need to do a little bit more," she said. She projected the U.S. unemployment rate to go beyond 4% up to 4.5% from more rate hikes by the Fed after the rate rose to 3.7% in May, marking the highest since October 2022, which was, I mean, just not long ago, right? If you think about it, October was not long ago. At least it doesn't feel like it was a long time ago. So some pretty troubling things that we're seeing. Now, I want to get a little bit more specific with you guys, because one thing that does have a pretty big impact on the CPI reports is used vehicle prices. Now, used vehicle prices have actually been trending higher recently. Ever since the end of 2022, really the start of 2023, used vehicle prices for SUVs, for cars, for pickup trucks, and luxury SUVs are all going higher. You can see these little charts right here. They bottomed out November of 2022, and they've been moving up ever since. Luxury cars, hybrids and EVs. I mean, hybrids and EVs are going up a little bit, but not nearly to the extent of the other four that we just mentioned. Luxury cars is really the only one that's going down. Vans is probably going up the most and seeing the smallest drop. So, not really the best signs that you're seeing there. Another area of concern is obviously rent prices. Back in March, you've seen rent prices hit 8.2% inflation. That is the highest reading you've seen since 1982. You've seen this kind of flatten out a little bit recently over the last 3 months or so, but you're not in what I would call a downside trajectory yet. You're not increasing, so it's very uncertain what's going to happen here. And this will have a big role to play in future Fed policy. Now, speaking of future Fed policy, the markets are currently assigning a 75% probability that the Fed will pause in June, but a 53.5% chance that the Fed will hike in July. I think the pause in June mostly going to come down to the inflation report that we get June 13th. That's going to make the ultimate decision whether they pause or whether they hike. And from there, I think the price of oil, renting prices, used car prices, food prices, these things are going to affect the decision making of whether we get rug pulled or not. And for equity investors, believe it or not, the weaker economic data starts to come out, the better it could be for lowering inflation, to getting back to a stance in markets where interest rates are no longer 5.5%, 6% on government bonds. You could actually lead more money to go into stocks. So when I kind of summarize this here, you're getting more upward pressure on inflation. Do I personally think oil is going to hit $100 a barrel? Probably not. You're gonna really have to see the economy hold up to get oil to hit $100 per barrel and to see an actual Fed rug pull. But it's going to be a very slow process to get inflation down. And I think this could be a massive wealth building opportunity for a lot of us, especially in stocks like Tesla or some longer growth, longer term duration companies. This is really a time where I would be sniping some of those opportunities for the next year or two. I really don't expect anything drastic to happen quickly. And that's what investing is. 5-10 years from now, you're going to wish the bear market lasted longer. And bear market, obviously, if you look at the indexes, you're not in a bear market, but Tesla's down 50% from its all-time highs. A lot of stocks are still down 70% or more from their all-time highs. High-quality companies, albeit not bad companies, high-quality companies. These are the times where real wealth is created. So let me know what you guys think about this down below in the comment section. Hit the like button, subscribe to the channel, and source your comments, questions, or concerns down below in the comment section. You guys have a great rest of your day, and I will see you in the next one.